First of all, what are you making of this, and how far, listening to those comments here, is it really currently about liquidity ultimately here as well? And is that the core theme? And is this just part of a broader impact of that? And don't forget, we've got these swap lines also being just organised by these 5 central banks, which are perhaps dealing with that liquidity issue. How far does this, is this responsible for what's happened with Credit Suisse, or was it a car crash in slow motion anyway?
Well, good morning. Yeah, I think it's a stunning development about what we've seen over the weekend, and I think it's a combination of both factors. We all know that Credit Suisse had some key challenges, but they did have a turnaround plan to fix some of those issues. But essentially, just over the past week, what we've seen is a crisis of confidence, and a $50 billion liquidity line from SNB mid last week didn't really help. So I think, given the announcement of the merger that we've seen, it will help to stem the confidence issue in the banking sector in the near term, but we're probably not out of the stress period just as yet, because if you think back, U.S. regional banks are still a concern, and there is still some work to be done to resolve the concerns around some of the smaller and weaker banks there.
And it seems like when it comes to bond traders, they're thinking that things have calmed down a bit. There's a bit of repricing here at the short end of the curve, and yields are actually higher now in Treasury markets. Is that the right assumption here, that the Fed can continue going?
Well, in the near term, the risk-on move that we have seen does make sense, right? We've seen stock futures move up. We've seen 2-year yields move up. But it's difficult to see this lasting sustainably just as yet. As far as the Fed is concerned, I think whether the Fed hikes by 25 basis points or not is still a close call. We are giving it a 60 to 70% probability of happening. But yes, a lot will depend on what are the concerns and how does the general market environment towards U.S. regional banks shape up in the next 2 or 3 days.
Do I buy this dip in Treasuries?
Well, I guess it depends on your time horizon. For us, when you're looking at 3 to 6 months time horizon, we would definitely use the increase in yields to add to Treasury exposures. Since start of the year, we have been overweight bonds, and we have been saying that the yield levels are quite attractive, and it makes sense to rotate out of equities, use any bounce in equity markets to rotate out of equities and move into high-quality investment-grade bonds. So yes, we would use the bounce in yields to reallocate to high-quality bonds.